So today we're going through chapter 14. It's regarding the cash flow. For the cash flow statement, it provides information that cannot be obtained from the balance sheets and income statements. So the balance sheets does not tell us what caused the cash balance to change. And in the same time, the income statement does not provide how cash flows were affected by the company's business activities. So this chapter is not an easy one, as it's the last chapters for managerial accounting. In this whole chapter explains how to classify transactions as operating, investing, or financing activities. After addressing this classification of different type of cash inflows and outflows, this also illustrates techniques for preparing the cash flow statements. So we mentioned about indirect method, direct method, and T account. Because this chapter we focus on indirect method, so I'm not gonna mention a lot about direct and T account. If you are interested in any of those methods, you can just go from our textbook. Is in the very back of the chapters. And so for the first part of the chapter 14, we first talk about the purpose of the statement of cash flow. So there are few questions can be answered. First one, are cash flow sufficient to support ongoing operations? Will the company be able to repay its debts? Will the company be able to pay its usual dividend? Why do net income and net cash flow different? And to what extent will the company have to? So the cash flow management is essential to the company's survival. The firm must be able to provide cash for itself to pay expenses, meet debt obligations, and to provide cash to owners. People looking at a company must ask not just whether it has enough cash to meet its obligation, but also where is the cash coming from? In today's society, we see that there are more efficient financial markets and more complexity. Highly liquid financial instruments, the concept of cash being available is not as important as cash equivalent, which consists of short-term, highly liquid investments, such as treasury bills, commercial paper, money market funds. So the firm can hold idle cash in those types of financial instruments because they're highly liquid and they can convert into cash very easily, right? So very important, the cash flow comes from payments received from accounts, cash sales, or borrowing. So we can see that the cash disbursement are for operating costs, dividends, purchase of assets, and paying loans. So this will give a good review of the source and use of cash. There is a chapter, exhibit 14-1 that was from our textbook. The whole exhibit explaining the net cash flow by analyzing the non-cash balance sheet account. So we can see that the first step is starting with a very basic equation that we have learned from our financial accounting in chapter 1. Assets equals liability plus shareholders' equity. So when it goes down, assets divide by cash and non-cash assets. So, and then they're changing cash, changing non-cash assets. So we have equals to change in liability, change in shareholders' equity. And then it goes down, when you separate your change in shareholders' equity equals net income, deduct dividends plus the change in capital stock. So people always get confused about this. So just remember, if you wanted to know the change in shareholders' equity, you need to know net income, dividend, and change in capital stock. So when you change this equation, you will get into the last equation. Net cash flow equals net income. Deduct change in non-cash assets plus change in liability. Deduct the dividends and plus change in capital stock. So this illustrates that cash inflow and outflow comes from more than just cash collected from sales and cash disbursement for expenses. And also we have to know that the difference in operating results from accrual-based accounting, which is required on all financial reporting, versus the cash-based accounting results. Now, this form, it shows that how each group of accounts will behave and impact on the change in cash. So we could see a few together, but if you have questions regarding this, you can go our textbook page 694. It has illustration of this whole exhibit 14-2. So we see accounts payable. If there are change in accounts payable, what is the impact on cash? We see accounts receivable decreased, right? We have our journal entry. If our accounts receivable decreased, which means that we use the cash to pay out or receive, that's receive the cash. So accounts receivable will be, means that we receive the cash, right, from our customers who owes us. So that means that our cash increased. So when you take a look at the impact on cash, we'll see increased. So when it helps you to prepare your cash flow statement. This just follow the rules. We have prepaid expenses, prepaid expenses. Prepaid expenses is sort of assets as well, right? So the prepaid expenses decreased, which means our cash impact will be increased. So will be the source. That's when we talk about source and use. Okay? Use means that you spend cash, but source means that you had inflow of the cash. So to be a very easy, remember that when you talk about assets, if the assets increase, the impact on cash will be decreased. But if it's liability increase, which means your impact on cash will be increased as well. So when you see dividends, so your dividends increase, which means that your impact on cash will decrease. That means you use your cash to pay out dividends. So that is how this form showed you. And it's really important for it because a lot of cash flow statements was formed and or illustrated in the later of this chapter will be referring to this -2. So if you have any questions regarding this one, pay attention to it because it's really important for it. Now, this classification of sources and use of cash. So that's the one we talk about. So the cash flow statement always starts with the initial incorrect assumption that net income equals the change in cash. So when you use your indirect method, you always start with net income, right? But that is an incorrect assumption. Why is that? We know that it is incorrect assumption. So the process we make a cash flow statement is the process to making the adjustment. We're going to talk about later regarding that. Why is an incorrect assumption? So for right now, if we need to construct in the statement of cash flow, we need to use changes. The net cash flows for a period is a function of the following, including net income, changes in non-cash assets, changes in liability, changes in capital stock accounts, or dividends paid to stockholder. Changes in the account mentioned on the period previous can be classified as either source or use of cash as shown. So we should have, okay, is not in here. So they will show source or use. We see that, for example, it's right there, where net income is always a source of cash. Okay, so we start with net income. Sorry. Net loss is always a use of cash because that means your outflow of your cash. Decrease in non-cash assets account are always source of cash. So decrease of non-cash assets, which means you have your plant, your machine, it's like a PPE, right? So is decrease, which means that you sold it and you have cash flow in. So that is a source, but it's decrease in non-cash assets, which means use of cash, because it means you spend your cash and get more assets in. The same increase in liability accounts are always a source of cash. Decrease in liability accounts, like account payable, right, are always a use of cash. Contract assets follow the rules of liability, like amortization, okay, depreciation expenses. Increase in capital stock accounts are always source of cash. Dividends paid to stock are always use of cash. That means dividends, increased dividends, that means that you spend your money to pay someone else's dividends. So that's why it's a use of cash. There are examples of sources and use of cash. For example, increase in non-cash assets accounts imply use of cash. We talked about this, right? If an inventory is purchased on credit from supplier, it implies that cash was used to acquire the inventory. So it's use of cash, it's outflow. Increase in liability accounts implies source of cash. So for example, if inventory is purchased on credit from a supplier, it implies that an increase in a payable has a factor of increasing cash available for other use. So that the account payable increased, so your liability increased. And then that means that there is an increase in cash available for other use. So you have that set of cash you can use for other things. So that's why is increase in liability account implies source of cash. Decrease in non-cash assets account implies source of cash. For example, if a account receivable decreased when a customer pays their bill, the company's cash balance will increase. Decrease in liability accounts implies use of cash. See, if a company makes a payment on a note payable, the company's cash balance will decrease, right? Because you made a payment, you have to spend money to make the payment. Now, when we talk about incorrect assumption of net income equals change in cash, so we put this depreciation journal entry as example. We know that if there's a depreciation happens, we debit our depreciation expenses and credit accumulation depreciation. So the depreciation is put on the income statement as expense because the expense increases and then your net income will decrease, right? But the cash account is not credit. We credit accumulated depreciation. So cash is not reduced by this entry. So when we're talking about depreciation expenses, they're only affected is net income. There's nothing affected by cash. So that's why we're talking about that, because this is accrued method, right? Accrued based accounting method. And we see that this is, so if net income equals change in cash, that's not correct, right? If you take a look at the depreciation expenses example. But if we practice the cash-based accounting, nothing will be realized until cash is received or paid. Then the net income will equals the change in cash. Right. So, but that is not what we learned from our financial accounting, because we learned that accrued accounting, the realized methodologies, the first rules we remember it, we learned from our financial accounting is that you're not realized until the cash is received, because you realize the revenue or the sales with account credit, right? As long as your products has been delivered to your customer, then you realize that as a revenue. Okay, so that's the differences between accrued-based accounting versus the cash-based accounting. Okay. So this is an example for simplified statement of cash flow. It's very straightforward. I think this is simple. It's from our textbook. We can take a look at it very quickly together. So CASI distribution, this is the income statement. So we have net sales, cost of sales, gross margin. Operating expenses, we have our net operating income. Non-operating items, we have a loss on sales, income before tax, income taxes, and then the net income. Net income is start point for the cash flow statement based on the incorrect assumption that net income equals change in cash. So we always start with net income. And then we have our balance sheets, right? We have 2009 balance sheets and 2008 balance sheet. We always do the comparison. So we see what's the changes. We just take a look at maybe cash and cash equivalent. We're 60 million in 2009 and 64 million in 2008. So we have 4 million decreased. So we have change minus 4, right? And then we could see just following all this, comparing different account. We could go PPE. So PPE has increased 42. So we put change and increased 42. And then the source or use, of course, is use, right? Because we spend money. So that's why our PPE increased in 2009. And that means that our equipment or PPE was acquired for in 2009. Accumulated amortization increased 21. So this is amortization for the year. When we go to liability, we have account payable, wage payable. So just following the rules, make the differences, and then you can figure out is the use or the source. Long-term liability. So there's a long-term notes payable increased 7. So that means that there are additional long-term notes has been borrowed. Okay, so we're borrowing more notes payable. And then the mortgage payable decreased, which means that we made a payment. So we have a 7, we made a payment. So it's used, we spent some money to make the payment. What else? Deferred tax increase. So that means that you're able to defer some tax into the future. You do not need to pay in this period, but you have deferred a few to the future to pay the tax. So there's some of the income expenses was not realized. Some income is not realized. That makes sense, right? Because your income taxes you need to pay it decreased. You defer to the future years. So in the current period, your income was not realized. Shareholders' equity, common stock increased 112, which means that we sold some common stock. Retained earning, we will talk about this in the return earning financial statements. Now we're in our returned earnings. We start our net income. It's always the source. We'll talk about this, right? Return earnings start with January 2015, 78. Dividends paid 237 as a use because we paid it out with cash. Now our return earning December 31st was is 86. So when we take a look at the balance sheet, and then our cash balance started in December 31st is 60, and our cash balance December 31st, 2018, I think it's not 2008. Oh, this is so confused. Okay, let's just say 2018, so 64. the net change in the cash balance is -4. Okay, now we put all the information together. We can have our simplified cash flow statement. This is not for reported purpose. It's just for analysis, right? Because you know that the formal statement of cash flow is different than this. So we start with our source of cash. We have our net income. We have decrease in non-cash, the PPE, decrease in account receivable. And then we just put all this information all together. You have your net change in cash is -4, which is equals your cash balance from the balance sheet, -4. So this is for our simplified cash flow statement. This does not allow the format required for external reporting purpose. So it's just, we said that it's just for illustration purpose only. Now we talk about the formal statement of cash flow. There are 3 sections: operating activities and inventory activities, financing activities. So we start with our operating activities. Operating activities are the activities that when you enter into the determination of net income. So generally speaking, operating activities includes all transactions affecting current asset, all transactions affecting your current liability, except for issuing and repaying a note bill. So this is not under operating liability. Okay. All changes in non-current balance sheet accounts that directly affect your net income, such as cumulative depreciation, amortization account. So we always remember the rules when you go through statement of cash flow. Changes in current asset and liability are reported in the operating section. Changes in long-term assets are reported in investing section. Changes in long-term liability and stakeholders' equity are reported in the financing section. Right, so just remember this when you need to separate it, which activities is under what kind of activities. So changes in current asset and liability are reported in the operating section, and long-term assets in the investing section, like you sell your PPE or you purchase the PPE. Changes in long-term liability and stakeholders' equity reported in the financing section. So next one, we talk about investing activities. So this relates to transactions involving the acquiring or disposing of non-current assets. We just talked about this, like PPE. Acquiring or selling PPE, acquiring or selling securities, such as bonds, stock of other companies held for long-term investment, lending money to another entity and subsequently collecting on the loan. Financing activities. Financing activity relates to transactions involving borrowing from creditors or repaying creditors, engaging in transaction with company's owners. Transactions with creditors that affect net income, such as interest on debt, are classified as operating activities. It's very confusing sometimes, right? When you try to make sure which one is what. So we just remember that if there is interest payable regarding a debt or regarding like those payable, that will be operating activities, because the interest payable will affect your net income in your income statement. Okay, now that's the most 2 important you need to remember. First one, to proper classification of stock and bonds transaction. It's very easy to get confused. So we have to emphasize that dividends received and interest earned are a part of operating activities instead of investing activities, dividends and interest earned. The reason is that dividends received and interest earned included in net income. That's what we talk about, is in your income statement. Transactions involving the purchase and sale of stock and bonds, however, are classified as investing activities. When you purchase or sell stock and bonds, because that will affect your shareholders' equity, right? But interest related to it or dividends related to it it will include it in your net income because it will affect your income statements. The next one, the proper classification of debt transaction also cause confusion. The interest paid to debtor is classified as part of operating activities instead of financing activities. Again, the primary reason is that interest paid on debt is included in net income. Transactions involving taking out and retiring notes are classified as financial activity. Okay. Make a note of those two sentences, and then it will help you when you do your tax, when you do your statement of cash flow. Okay. Now, the format of the statement of cash flow, indirect method, general overview. Cash flow are divided into three categories: operating, investing, financing activities. The beginning cash balance is reconciled with the ending cash balances. Okay, so we go from the operating activities. The general format for this section includes those activities that enter into the determination of net income. As a reminder, sources of cash are added to net income and use of cash are deducted from net income. So there are some examples we'll show. Decreases in current non-cash assets will be added to net income. Increase in current liability will be added to net income. Increase in current non-cash assets will be subtracted from net income, PBE, right? And then decrease in current liability will be subtracted from net income. Depreciation charges are treated as current liability. So if increase your depreciation, they're added to net income. Gains are subtracted from net income. Losses are added to net income. So why the cash provided by operating activities is very important? That's the question we're asking. The answer is that this figure provides a signal concerning the ability of operations to generate a positive cash flow. A positive cash flow is really important regarding a company, if it's survival or not. So if a company whose operations generate negative cash flow, that means the company is in trouble. So that's why we say the cash provided by operating activities is really important. Okay. Now we're going to investing activities. Investing activities includes the transaction that involve the acquisition or disposal of non-current assets. We talk about this in the PBE so many times. Financing activities. The financing activities includes those transactions that involve the receipts from or payment to creditors and owners. Okay, so there are other issues in preparing the statement of cash flow. First one, we use gross amount or net income, a net amount. So for both financing and investing activities, items on the statement of cash flow should be present in gross amount rather than in net amount. Okay, for example, if Mary's department store purchased 50 million in property during the year, and then they sell other property for 30 million, instead of showing the net change of 20 million, the company must report the gross amount of both transactions. That makes sense, right? You cannot just show there is a net change. You earned 20 million. You have to show that you purchased 50 and you sell 30, and then you have 20 increase. The gross method of reporting does not extend to operating activities, where debit and credit to account are netted against each other. So this gross method does not apply to operating activities. It's only apply for financing and investing activities. Okay. Now, The second one, operating activities are used direct or indirect method. Basically, we use indirect method in this chapter. The direct method on the cash basis, for example, cash collected from customer is used instead of revenue, and payment to suppliers is used instead of cost of sales. So those are different rules. But the indirect method, we construct the operating activity section of the statement of cash flow first, starting with net income, adjusting to cash basis. Items that do not affect cash flow are removed from net income, thereby showing the reasons why net income differs from net cash provided by operating activities. If a company decides to use an indirect method to determine net cash flow from operating activities, there's no requirement that it also report the result using the direct method. So actually, most 99% of the companies will use the indirect method right now for external report. Yeah. Okay, part 3, indirect method. We gave a preparing a cash flow statement using indirect method. Now, with this example, we start our net income. An adjustment needed to convert net income into cash basis. Depreciation. Changes in current asset account. So our increase in our account receivable, so our cash effect will be decreased. We decrease in prepaid expenses, our cash effect will increase. Increase merchandise inventory is a decrease. Okay. So there's a net cash provided by operating activities is 248. Now, this exhibit 14-9 is a very detailed explanation of adjusted changes in current liability accounts. It's very useful form because it gives you a very detailed analysis. For example, cash receivable. We have talked about this quite a few times. So when you see cash receivable, account receivable, and when we see account receivable increases, so that means that the sales have been reported, but there's no cash has been collected. So how are you going to do your journal entry? You debit your account receivable, you credit your cash or sales. And then when your account receivable decreased, which means that you debit your cash, you receive more cash, and then you credit your account receivable. So you will see that according to the journal entry, when your account receivable increase, the cash affected will be decreased. If your account receivable decreases, the effect to cash will be increased. Right. The same explanation for the rest of the inventory, prepaid expenses, account payable, or tax payable. So you can definitely take a look at this, and also you can find this from your textbook. Now we're talking about 8 basic steps to preparing the cash flow statements. The first step, we copy all those accounts from your balance sheet. The second, we compute the changes in the balance of each account over the period. And then we code each change as a source or use of cash. Now in the cash flow effect column, we write resources as a positive number and use as a negative number. Make a required adjustment to reflect gross, no net amount. And then when you finish, you classify each item as operating, investment, or financing. Step 7, you transfer data for worksheets to formal statements. We always following the operating first, then investing, and then last is financing. Number 8 is reconcile changes in cash and cash equivalent. Okay, so I'll give you a very detailed examples right now. So during the year, this example will be record the loss on sales of equipment and the cash. The cash flow statements worksheets can be prepared in order to prepare the formal cash flow statements. So during the year, we sold equipment listed in accounts of Kazi distribution as having a value of $14,000 and with accumulation amortization of $3,000 for $5,000 cash. So we record this in journal entry. We sold our equipment for $14,000. That's our value, right? But we sold for cash $5,000. So increase our cash increase 5,000. Accumulated amortization 3,000. And then the loss on sales have a 6,000. Okay, so that's our journal entry. Now we're following our step 1 to 7. Quickly examples. Asset. Okay, so we have our current assets. The first step will be copy all those information from their balance sheets. So all those info I didn't show in there. That's a step 1. So just simply copy the current assets, non-current assets, equipment, and also you get all the accounts shows up. So you go step 2. You just calculate the changes, right? So account receivable decreased, so -5, and this is source or use. It's a source, right? Because it's decreased account receivable, so our cash is increased, so it's a source. So the cash effect will be the +5 because it's a increase of the cash effect. And then there's nothing you need to adjust it for gross or net. And then 6 adjust effect is 5, and classification is operating activities. Now the same for prepaid expenses, increase 1, so use is decrease is use, so it's decrease our cash flow in fact -1, and adjust effects -1 is operating activities. Merchandise inventory increase 9 is use, so is cash flow is -9, and adjust effect is -9 is under operating activities. So if following all those step 1 to 7, you can finish all this balance sheets. That's the first 7 steps when you start doing a cash flow statement. Now, we need to make some adjustment. There are 2 parts. One is we sell the equipment, right? The value of the equipment is 14,000. And then it's right there, we show. So our ending balance on December 31st is 458. Beginning balance on January is 416. There's a value of equipment sold is 14,000. So when that's our value of the equipment sold, the net equipment value will be 402. So the required equipment purchase is 56. Before this 2 adjustment is before we form the cash flow statement. This PPE and accumulated depreciation is the effect by the sales of the equipment. So the 56 will be the required equipment purchase. So that will be goes to your cash flow statement. And when you go to accumulated depreciation, we will see that their ending balance will be 127, beginning balance 106. The value of the equipment sold is 3, right? The 3 is the accumulated depreciation. And then the net beginning of accumulated depreciation is 103, requirement depreciation is 24. So when you take a look at the first one, the beginning and ending balances difference in the equipment will be 458, deduct 416, there's 42. That doesn't include the requirement of CASA distribution to replace the 14,000 equipment sold. So the actual value of the equipment purchased was 56, with 42 plus the 14,000 value of the equipment sold. The second for accumulated depreciation, we use simply ending balance deduct our beginning balance for amortization depreciation will be 21. This does not include the 3,000 of accumulated depreciation eliminated because the equipment was sold. So the accumulated depreciation should be eliminated for 3,000. So we need to add it back to our total depreciation that occurred during the year. That will be 24. So 24, that's the adjustment we just made. And you can also see from step number 5, equipment accumulated depreciation. So the total amount will be shown in your cash flow statement will be after adjustment. Then it goes to the indirect method cash flow. We start our net income always, and then we'll adjust it to convert net income to a cash basis. Depreciation 24. Yeah, we just made the changes. Now we have decrease in account receivable 5. Those are following what you have to do from your step 1 to step 7. Now you have finished your net income provided by operating activities, and then you finish your investing activities, and then you have finished your financing activities. So your net change in cash and cash equivalent is -4. Now your beginning cash equivalent is 64, ending balance will be 60. So that's all from your balance sheet, right? So it's match. So that will be everything for indirect method to compare to complete it or a cash flow. And it also mentioned a little bit about direct method because it's not in this chapter's main topic, so we're not going to talk about it. The only thing I want to mention is for T account approach. So this is a T account approach. I just want to show you because people are always get confused about return earnings, about dividends paid, right? So they will show you debit or credit. The focus of the cash flow statement is to analyze the changes in cash over the period. If all the individual accounts are adjusted by the use of accounting entry, debit or credit each account as necessary. So you could see that if it's debit, then it's increase the balance in cash. If it's credit, will be decrease the balance of cash. So we just quickly show your return earnings journal entry. The net income increase return earnings with debit or cash, credit or return earnings. Dividend decrease the return earning, right? Because we paid cash. So with debit, return earning, credit, cash. So just following, we have a change of our accounts receivable, right? Decrease our account receivable, which means we received cash, and debit cash, credit account receivable. So that's basically a T account methodologies. It's just show you all the journal entries. Not important, as just give you explanation about this method. But so focus on your indirect method for this chapter, and then you should be fine. Thanks for watching.